For many households, the change does not begin with a headline or a policy decision. It appears quietly, in a number that moves higher without warning. By late April 2026, the national average price of gasoline had reached a range of $4.18 to $4.23 per gallon. In California, it was approaching $5.97. For a middle-class household, that difference is immediate. A daily commute becomes more expensive. Weekly fuel spending increases. Over time, those changes begin to affect how money is allocated across other necessities. This is not a sudden event. It is the visible outcome of pressure building inside the fuel system. At the same time those prices were rising, state watchdogs began examining whether some increases were moving beyond what underlying costs would justify. Investigations were opened in states including California and Nevada after localized price spikes triggered consumer complaints. The focus of those investigations is specific. Regulators are not responding to high prices alone. They are evaluating whether certain price increases are disproportionate to the actual cost of fuel. In legal terms, price gouging is defined as an increase that is grossly disproportionate compared to cost changes. That standard exists across multiple states, with enforcement mechanisms already in place. In Florida, penalties can reach up to $1,000 per violation, with total fines exceeding $25,000 per day. In Texas, violations during declared emergencies can result in fines of up to $10,000 per occurrence. Public statements from state agencies reflected that framework. The California Attorney General's office stated that it would not tolerate price gouging at the pump. The Nevada Attorney General's office emphasized that consumers should not be taken advantage of during market disruptions. These statements were made during a period when the fuel system itself was under measurable strain. In early April 2026, refinery disruptions began to affect production in the Midwest. Facilities associated with companies such as Marathon Petroleum, Phillips 66, and BP experienced outages that reduced total refining capacity. By mid-April, the combined impact had reached approximately 800,000 barrels per day of lost output. That reduction is not theoretical. It represents fuel that is no longer being produced and distributed. Refineries are a critical stage in the fuel supply chain. Crude oil must be processed into usable products such as gasoline and diesel. When refinery capacity is reduced, the volume of finished fuel entering the market declines. At the same time, demand does not immediately adjust. Drivers continue to commute, freight continues to move, deliveries continue to arrive. The balance between supply and demand becomes tighter. That tightening begins to influence price. As April progressed, inventory levels began to reflect the same pattern. According to data from the U.S. Energy Information Administration, gasoline inventories declined by approximately 6.1 million barrels. Crude oil inventories fell by about 6.2 million barrels. Diesel supplies decreased by roughly 4.5 million barrels. These figures indicate a system drawing down reserves, while production is constrained. The sequence can be followed step by step. Refinery disruptions reduce output. Reduced output limits supply. Lower supply leads to increased competition for available fuel. Prices begin to rise. For households, that sequence is not visible in stages. It appears as a higher price at the pump. During this same period, another factor was developing in parallel. Exports of U.S. fuel products were increasing. Crude oil exports reached approximately 6.44 million barrels per day, while total fuel exports rose to around 14.18 million barrels per day, both representing record levels for the timeframe. This creates a condition where fuel continues to move out of the domestic system while inventories are declining. From an operational perspective, the system remains active. Production continues, distribution continues, and international demand is met. But within the domestic market, available supply becomes more limited relative to demand. That limitation contributes to price pressure. At this stage, it is important to distinguish between system-driven price increases and potential pricing behavior at the retail level. Gas stations operate at the final stage of the supply chain. They purchase fuel at wholesale prices, add transportation costs, and apply a margin before selling to consumers. Under normal conditions, that margin is relatively small, typically in the range of 10 to 20 cents per gallon. Most gas stations rely on convenience store sales for a larger share of profit. Fuel itself is often a low-margin product designed to attract traffic. However, during periods of volatility, margins can shift. Rapid changes in wholesale prices, supply constraints, and regional disruptions can create conditions where retail prices move quickly. This is where regulatory scrutiny begins. State investigators examine whether the difference between wholesale cost and retail price expands beyond what would be expected. The process involves comparing purchase costs, transportation expenses, and final sale prices. If the gap increases in a way that cannot be explained by underlying costs, it may be classified as price gouging. At the same time, it is also recognized that not all price increases are violations. In a constrained market, prices can rise rapidly while still reflecting legitimate supply conditions. The distinction depends on whether the increase is supported by cost data. By mid to late April, several indicators were moving in the same direction. Refinery capacity had been reduced by approximately 800,000 barrels per day. Gasoline inventories had declined by 6.1 million barrels. Crude inventories had fallen by 6.2 million barrels. Diesel supplies were down by 4.5 million barrels. Exports were at record levels, with crude at 6.44 million barrels per day, and total fuel at 14.18 million barrels per day. Each of these factors contributes to the same outcome, a tighter supply environment. When multiple constraints occur simultaneously, the effect is cumulative rather than isolated. For a household, this accumulation is reflected in daily expenses. A higher cost per gallon increases commuting expenses. Over time, those increases affect the cost of transporting goods. As transportation costs rise, they begin to influence the price of items that depend on fuel for delivery. This transmission effect moves gradually but consistently through the economy. At the same time, the presence of investigations introduces an additional layer of uncertainty. Consumers may not be able to distinguish between price increases driven by supply conditions and those that may be under review by regulators. The result is a perception of instability. Prices are rising, and the reasons are not always visible at the point of purchase. By the end of April, the national average price had moved firmly above the $4 threshold. That level is significant because it represents a point at which fuel costs begin to affect a broader segment of households. In regions where prices approached or exceeded $5, the impact becomes more pronounced. The underlying system, however, does not operate at the level of individual transactions. It operates through production capacity, inventory levels, and distribution flows. At that level, the data shows a consistent pattern. Production was constrained due to refinery outages. Inventories were declining across multiple categories. Exports were increasing, drawing supply outward. These conditions reinforce one another. Reduced production limits the ability to rebuild inventories. Lower inventories increase sensitivity to disruptions. High export volumes reduce the buffer available for domestic consumption. The combined effect is a system operating with less flexibility. In such a system, even small disruptions can have a larger impact on price. For households, this reduced flexibility translates into less predictability. Fuel costs become more variable. Budgeting becomes more difficult. At the same time, regulatory oversight remains active. Investigations in states such as California and Nevada continue to examine whether pricing behavior aligns with cost structures. No large-scale penalties had been confirmed during this period, but the process itself reflects ongoing scrutiny of the market. This intersection between system pressure and regulatory review defines the current moment. Prices are rising, supply is constrained, inventories are declining. Investigations are ongoing. For households, the impact is already present. It is reflected in the cost of each gallon purchased and in the frequency with which that cost changes. The broader system continues to adjust, but the immediate effect remains centered on daily expenses. This is where the situation stands at the end of April 2026. As April moved forward, the conditions that had begun earlier in the month did not stabilize. Instead, they continued to reinforce one another. The system remained under pressure, and the signals coming from production, inventories, and distribution all pointed in the same direction. Refinery output had already been reduced by approximately 800,000 barrels per day due to disruptions across facilities associated with Marathon Petroleum, Phillips 66, and BP. That level of lost capacity was not quickly recoverable. Refining operations are complex, and when output is interrupted, restoring full production takes time. During that period, the system must operate with less finished fuel entering circulation. At the same time, the demand side of the equation remained consistent. Fuel consumption does not adjust immediately in response to supply disruptions. Commuting patterns continue, freight routes remain active, and distribution networks maintain their schedules. This creates a situation where the system is required to meet ongoing demand with reduced output. Under those conditions, inventories become the balancing mechanism. Stored fuel is used to bridge the gap between production and consumption. However, by mid-April, those inventories were already declining. Gasoline stockpiles had fallen by approximately 6.1 million barrels, crude inventories by 6.2 million barrels, and diesel supplies by 4.5 million barrels. This pattern reflects a system drawing down its reserves at the same time that its ability to replenish those reserves is constrained. When both of these factors occur together, the margin for error becomes smaller. There is less capacity to absorb additional disruptions, and the system becomes more sensitive to changes in supply or demand. In practical terms, this sensitivity appears as price movement. With fewer reserves available, each unit of fuel becomes more valuable within the market. Prices adjust to reflect that tighter balance. During this same period, exports continued at elevated levels. Crude oil exports were measured at approximately 6.44 million barrels per day, while total fuel exports reached around 14.18 million barrels per day. These figures represent a continuation of outward flow from the domestic system. Exports are part of normal market operations, but their effect becomes more pronounced when domestic supply is already under pressure. As fuel leaves the domestic market, the remaining supply must cover the same level of demand. This adds to the overall tightening effect. The interaction between reduced production, declining inventories, and sustained exports forms a consistent pattern. Each factor alone would influence pricing, but together they create a compounding effect. The system is not responding to a single disruption. It is adjusting to multiple constraints at once. For households, this compounding effect is experienced through the steady increase in fuel prices. The national average moving above $4 per gallon reflects the combined influence of these factors. In regions where prices approached $5 or higher, the same underlying pressures are present but more pronounced. At the retail level, gas stations operate within this broader system. They are not setting prices independently of market conditions. They are responding to changes in wholesale costs and supply availability. However, the speed and scale of retail price adjustments can vary. This variability is one of the reasons investigations were initiated. Regulators examine whether retail prices are moving in proportion to underlying costs, or whether additional factors are influencing pricing decisions. The process involves reviewing purchase records, transportation costs, and final sale prices to determine whether margins have expanded beyond expected levels. At the same time, it is recognized that volatility in the market can lead to rapid price changes without violating regulatory standards. When supply is constrained and costs are fluctuating, retail prices may adjust quickly to reflect those changes. The distinction between legitimate price movement and potential price gouging is based on data rather than perception. Investigators rely on documented cost changes to assess whether pricing behavior is justified. While these investigations were underway, the broader market continued to operate under constrained conditions. Refinery utilization was reported at approximately 89.6%, indicating that facilities were operating at a relatively high level of capacity overall. Despite this, the earlier outages meant that total available output remained below normal levels. Crude production was measured at approximately 13.6 million barrels per day, reflecting steady upstream supply. However, crude production alone does not determine gasoline availability. The refining process is required to convert crude into usable fuel, and it is within that stage that the constraint had developed. This distinction is important because it explains why overall production levels can appear stable while gasoline supply becomes tighter. The limitation is not in the availability of crude oil, but in the capacity to process it into finished products. As these conditions persisted, the market began to reflect a reduced level of flexibility. With inventories lower and production constrained, there was less ability to respond to additional disruptions. The system had fewer buffers. For households, this reduced flexibility translates into increased exposure to price changes. When the system operates with limited reserves, prices can adjust more quickly and more frequently. This makes fuel costs less predictable. The effect is not limited to direct fuel purchases. Transportation costs are closely tied to fuel prices. As those costs increase, they influence the pricing of goods that depend on transportation. Over time, this creates a broader impact on household expenses. The transmission of these costs is gradual but consistent. A higher cost at the pump affects delivery networks, which in turn affects retail pricing across multiple categories. The result is a shift in the overall cost structure faced by consumers. At the same time, the presence of regulatory investigations introduces an additional element of oversight. While the market adjusts to supply conditions, regulators continue to evaluate whether pricing practices remain within acceptable boundaries. In states such as California and Nevada, the focus remains on identifying cases where price increases may not align with cost changes. Consumer complaints play a role in initiating these reviews, but the outcome depends on detailed analysis of pricing data. By the end of April, no large-scale penalties had been confirmed, but the investigations themselves reflect continued attention to market behavior during a period of volatility. The broader pattern remains consistent. Production has been constrained due to refinery outages. Inventories have declined across gasoline, crude, and diesel. Exports have remained elevated, contributing to tighter domestic supply. Prices have increased in response to these conditions. Each of these elements is connected. They are not isolated developments, but part of a system adjusting to multiple pressures at the same time. For households, the result is experienced as a steady increase in fuel costs and a reduction in predictability. Budgeting becomes more difficult when prices change frequently and without a clear pattern. As the system continues to operate under these conditions, the relationship between supply constraints and pricing remains central. The market reflects the balance between available fuel and ongoing demand, and that balance remains tight. This is the environment in which both consumers and regulators are operating. The system has not yet returned to a more stable state, and the pressures that developed in early April continue to influence conditions at the end of the month. By early May 2026, the system had not returned to balance. The same pressures that had developed through April were still in place. Refinery output had not fully recovered from earlier disruptions. Inventories remained lower across gasoline, crude, and diesel, and export levels continued to draw supply outward. Refinery utilization remained at approximately 89.6%, indicating that much of the available infrastructure was operating at a high level. Crude production held near 13.6 million barrels per day. These figures suggest that the system was active, but not operating with excess capacity. The earlier loss of roughly 800,000 barrels per day of refining output had reduced the margin available to absorb demand. That margin is critical in a fuel system. When capacity is limited and inventories are already declining, the system becomes more sensitive to even minor disruptions. Under these conditions, price movements tend to occur more frequently and with less delay. For households, that sensitivity appears as volatility. Prices do not remain stable long enough to establish a predictable pattern. Instead, they adjust in response to shifts in supply and distribution that are not visible at the point of purchase. At the same time, the decline in inventories continued to shape market conditions. Gasoline stockpiles had already fallen by approximately 6.1 million barrels, crude inventories by 6.2 million barrels, and diesel supplies by 4.5 million barrels. These reductions represent fuel that has already been consumed without being fully replaced. Inventories function as a buffer between production and consumption. When that buffer is reduced, the system has less capacity to stabilize prices. Each additional change in supply or demand has a more direct impact on pricing. Exports remained elevated, with crude shipments at approximately 6.44 million barrels per day, and total fuel exports at around 14.18 million barrels per day. These flows continued to move fuel out of the domestic market, while inventories were declining. From an operational standpoint, exports are part of standard market activity. However, in a constrained environment, their effect becomes more pronounced. As supply leaves the domestic system, the remaining volume must meet the same level of demand. This reinforces the broader pattern that had developed through April. Production constraints, inventory declines, and sustained exports were not isolated developments. They were interconnected factors shaping the same outcome. That outcome is a tighter supply environment with upward pressure on prices. At the retail level, this environment defines the conditions under which gas stations operate. Stations continue to purchase fuel at wholesale prices, add transportation costs, and apply a margin before selling to consumers. Under normal conditions, that margin remains relatively narrow, typically between 10 and 20 cents per gallon. During periods of volatility, however, pricing adjustments can occur more rapidly. Wholesale costs may change quickly, and retail prices may follow those changes with varying timing. This variability is one of the factors being examined by state regulators. Investigations in states such as California and Nevada continued into early May. These reviews focused on determining whether price increases at specific locations were consistent with underlying costs, or whether margins had expanded beyond expected levels. The process relies on documented data. Regulators compare wholesale purchase prices, transportation expenses, and final retail prices. When discrepancies appear that cannot be explained by cost changes, further action may be considered. At the same time, it is recognized that not all price increases indicate a violation. In a market where supply is constrained and inventories are low, prices can rise quickly while remaining consistent with actual costs. By this stage, no large-scale penalties had been confirmed. The investigations remained ongoing, reflecting continued oversight rather than concluded enforcement. For households, the presence of these investigations does not change the immediate experience. The cost at the pump remains the primary point of impact. However, the oversight process reflects an attempt to ensure that pricing remains aligned with market conditions rather than exceeding them. The broader system continues to operate within the same constraints. Refinery capacity has not fully returned, inventories remain below previous levels, and export flows continue at elevated rates. These factors limit the system's ability to return to a more stable balance. The effect on households extends beyond fuel purchases. Higher gasoline prices increase commuting costs, which are a direct and recurring expense. Over time, these increases influence transportation costs across the economy. As goods are moved through distribution networks, higher fuel costs contribute to higher prices in other categories. This transmission of cost is gradual but persistent. It does not occur all at once, but it affects multiple areas of spending as fuel remains a core input in transportation and logistics. At the same time, the reduced flexibility of the system affects predictability. When inventories are low and production is constrained, prices can change more frequently. This makes it more difficult for households to anticipate future costs. Budgeting becomes more uncertain under these conditions. Expenses that were previously stable begin to vary, and the range of possible outcomes widens. By early May, the system remained in this state. The pressures that developed in early April had not been resolved, and the indicators continued to reflect a constrained environment. production capacity had been reduced and had not fully recovered. Inventories across gasoline, crude, and diesel remained lower. Exports continued at elevated levels. Prices remained above the $4 threshold nationally, with higher levels in certain regions. These elements define the current reality. They are not projections or forecasts, but conditions that are already in place. For households, the impact is ongoing. It is reflected in the cost of fuel, the frequency of price changes, and the broader influence those changes have on everyday expenses. The system continues to adjust within its constraints, and regulators continue to monitor pricing behavior. The balance between supply and demand remains tight, and the effects of that imbalance are already visible at the point where consumers interact with the market. This is where the situation stands as of early May 2026.